Hey
Very
everybody, we are here with Tom Basso once again. Tom was one of our favorite guests on here last time. Everybody was really excited to see him. I'm excited to see him again. I want to bring him on. He has a new book that just came out. I just got a chance to read it. It's really good. It's called The All-Weather Trader. Mr. Serenity's thoughts on trading, come rain or shine.
yeah.
Um, First off, how did you come up with that name? How did you get the name Mr. Serenity? I know you've been asked that a million times, but there's some of our listeners who just don't know.
Well, the I'll answer the two questions separately here. The
Hmm.
first is, how did I get Mr. Serenity as a tagline? That was thanks to Jack Schwager and the New Market Wizards. If you read my chapter in that book, he'll talk a lot about my calmness in trading and my sort of command of figuring out what I want to do and then executing it flawlessly without a whole lot of stress involved. And he thought that was very different from a lot of the traders and some of the market wizards book. If you read those books, you'll see that a lot of them are highly stressed, and you have this picture of Wall Street the movie with too many martinis consumed and smoking and maybe drugs and who knows what, and burnout after 10 years in the business. And here I was just cruising along, smile on my face. So I think that's where Mr. Serenity came from. And I've kind of been tagged with that for the last, nearly 30 years now, I'd say. The title of the book comes from a lot of discussions with myself and Eric Crittenton of Standpoint Funds, who's a really sharp cookie, a very good, practical trading guy that knows his stuff. And I'm the chairman of Standpoint Funds, to be full disclosure and everything. So Eric and I have become very close and friends over the years. I've known him for probably 20 years. And the term, he uses that term, and I kind of have developed a lot of my stuff with the help of various software that I've used over the years, with a lot of discussions with Lawrence Bensdorp, who I do a seminar with coming up this next October in 2023. Every now and again, if our schedules line up and we are in the mood, we'll put on one of these seminars and just have fun with it. And they're only for 15 people, so it's a very small group. We can control what goes on a lot better, and I think the traders get a lot more out of it because it's more one-on-one rather than have 50 people in a room or something.
Yeah.
And the term all weather means you're dealing with up markets, down markets, and sideways markets in the market when you're trading. I mean, stock market historical simulations that I've done over the last 40, 50 years of the Standard & Poor's 500 show that about 60% of the time you're in an up market, about 10% you're in a down market, and the rest of the time, excuse me, that's wrong. 40% you're in an up. Is that right? 30, 10, 60. 60
Hmm.
you're in a sideways market, 30 you're in a up market, and 10 you're in a down market. So if you get that into your head and you realize that a lot of traders, especially the ones that had their stimulus checks around COVID, got into an up stock market, made a bunch of money, and immediately thought they were geniuses. They were only dealing with 30% of all time in the market over the
Yes.
last many, many decades. You got to have an idea of what to do in that 10% when you get ripped to shreds on the down market. Could you try to create something that makes money during that period, like a hedging strategy, or like time yourself out and go to cash, or do other things? There's lots of different strategies that will attempt to deal with the risk of a down market. But then 60% of the time, you're sitting there and it's going nowhere. And
Hmm.
you got to be patient. You got to deal with your frustration and your impetuous nature. And if you've had too much coffee that day, you really want to make a trade, darn it. And reality, you should be just sitting on your thumbs and watching it because nothing's happening. And so I like to keep in mind those time frames, the 60-40, 60-30-10, because
Hmm.
those are approximations. And it gets you in the proper perspective to know that the 10% that you have the down markets are twice or three times as volatile as the 30% that are up. And the sideways goes on for long periods of time. There's been sideways that last for years. So when you're trying to become all weather, you're trying to create strategies to deal with all types of weather. It can be a sunny day, great. I put on, for those days, I put on sunblock and go out and hit balls, and that's the strategy for that day. On the 10% day, it's monsoon rains and thunderstorms. Okay, stay inside, work on other projects. That's going to be the strategy that day. Sideways, everything's normal. It's just a partly cloudy day. I can do whatever my normal routine is. As you have strategies for different days, and I think that's where I came up with the title. And Eric calls what he does at Standpoint is also all weather. It deals with a lot of different types of conditions.
I love that. And I really liked what you talked about in the book too, with dealing with sideways. As trend followers, we don't talk about that very much because it is very true. You get in these periods and they're long periods of time. And it doesn't matter if you're trading across all these different assets, there's still going to be very long sideways periods. When liquidity gets tight, sometimes everything gets stuck in a range. And
Yep.
so just kind of talking about that, because trend following is, it's my favorite style of trading, but the one thing that makes it very tough is those periods. Those periods, yeah, you could sit there and, get hammered back and forth or get chopped to death. Or you can kind of come up with different strategies. And I
Mm-hmm.
like the idea that everything you still have, like in the book, talked about still having a system, being systematic, almost even like short-term trend following style of trading, or like all these different ETFs you're talking about now and so on. So I love the strategy and the idea. So let's get into, you said something that was really interesting in the book, and when you were talking about strategy, you talked about filling the potholes.
Yeah.
you know for me, I was like, wow, that's, so there's a person in my group, and they were just having a conversation with me, and this was about they're getting like to a good point in trading, and they're creating these systems and they're doing well, but they feel like they're still just kind of missing something. And I love the way you explain that in the book, because that's the truth. It's like there really is this piece that's kind of always missing, whether it's risk management or something. There's something there. Can you explain that a little bit more?
Yeah, I have to credit Lawrence Bensdorf for this one. I heard it in one of the seminars we were teaching, or the 15 students in the seminar, and Lawrence threw that out there, and I looked up and wow, that's perfect. I love
Yep.
this. And I've used it ever since, giving him credit for it fully. But it's kind of like your straight line going up the graph, your equity curve is what everybody would love to have, like 30% a year straight line. Well, the reality is it's not a straight line. Mine has never been, but it's a lot straighter than it used to be. And I think what you get this philosophy of is the straight line is, if you think of it as an uphill road, there's potholes in the road. And those are not fun. Your tires do not like going through them. You don't like going through them. So if you can spend some time thinking about what has created the pothole. So, okay, the market has done something. The indicators and the strategies that you've decided to trade have reacted to that, and losses ensued. So your equity curve did a little pothole. If you could then let your mind wander and ask yourself what kind of strategies might be useful in making money exactly during those periods, concentrate on that first. And just try to understand, when markets go into a down direction, well, things like hedging kick in and try to make money when the market goes down. All right, well, that's fine. That'd be one aspect of it. How about timing myself out of the market? Well, you're going to take a little time to get to your indicator, to your stop loss, but that would be another way to mitigate a very large pothole, perhaps.
Mhm.
And there may be other things like credit spreads or other things you could do during sideways periods where instead of getting chopped with your trend following models and buying and selling and buying and selling and buying and selling, and you're taking small losses because that's the nature of trend following. Let your gains run, cut your losses short. But after you do 2 or 3 losses in a row, it kind of starts adding up, and you take a few percent here and a few percent there. Before you know it, you're down 10%. And so I like to think of the problem is you're trying to solve using the type of market that you had a rough period through with your existing strategies. What new strategy might you come up with that would actually make money during that period? It's ideally suited to make money. Once I have that in place and I have it in my mind, now do a study about what would that strategy do during all of time, the good periods and the up periods, down periods, all the different other times when your strategies were already doing extremely well, and we're creating that nice smooth line. And what you're doing is filling the pothole. You find yourself just kind of squeezing those little disruptions along the way, squashing them down a little bit. And so that's why we call it filling the potholes. Lawrence and I both use those terms now, thanks to him. And I think it's a perfect way to think of it. So
I love that. And
by the
for
way,
me,
what if you're trying to find a new strategy to trade, where would you start? I would start with your potholes.
yep. No,
Perfect
it's
place
the
to
truth.
start.
It was so well said, and that's the reason why people, if you're listening to this, you got to pick up the book, because that part of trading is something I think it affects all of us. Whatever your strategy is, there's always periods like that. There was a time when, for me, my first filling the potholes idea was trading the VIX in kind of a trend following way. Finding a Bollinger Band strategy that I still use to this day. And you can, and then like you said, credit spreads and so on. And for me, most of it still is systematic. Like, I'm still systematizing most of these, back testing, making sure it works just like a good trend follower would. But even for me, there's certain trades, like in equities, there might be a more mean reversion trade style. There might be a more range style of trade, going on using options. Like, all of these are really, really good. And then during those periods, like you said, like, I think that was my favorite part in the book, is thinking about it and going like, oh, in my really good periods, is it hurting me or helping me, even, and then weighing that all together, putting your strategy together, and then going from there. Like, I really like that.
Well, and it can happen the opposite way. I'm a trend follower by very nature, and more longer term in my business back at Trendstat days when I was managing other people's money. And Eric, for instance, has got to be very long term. He's moving potentially billions down the road. So his strategy is designed around that, which is, I think everybody needs to look at the puzzle they're trying to solve and come up with their own solutions. I don't think anybody wants to copy just what Eric does or just what I do or just what Lawrence does. I mean, everybody's got their own wrinkle on it. And what I find is, let's say you get traders that are very, say, short term, and or mean reversion, they're swing trading, they're range trading, those types of folks. And they may struggle when you get these pegged out trending markets where, I mean, every day it's just another day up and another day up and another day up, and fear of missing out and risk on, and everybody is just hard charging the stock market and is just making new highs every day. In those time periods, maybe some of those traders that are range traders are going to struggle. Well, maybe they need to, add a little trend following to their stuff and pick up some of those big moves that help pay for some of the down periods that they'd suffer from range trading. So I think it works for whichever way you approach trading. Having a little bit of a lot of different strategies just smooth things out. It's like a fund of funds manager hiring 9 or 10 different managers that do different things. He's smoothing out his overall track record.
Yeah, and I always talk about that in the sense, just like you said, like thinking of myself as possibly many traders. Maybe I have this style here. Maybe I'm a short-term trend follower, a mid-term trend follower, a long-term trend follower. And as I'm thinking about that, and I think, the first time I ever heard, a real trend follower talk about that was you, which is you talk about the same thing with having these short-term, mid-term, long-term systems that you'll have in your trend following models. You
Yeah,
know,
it really comes down to diversification by market, diversification by time period, diversification by indicator even. You could have, if you use a Bollinger and a Keltner, those are two different indicators. They're not going to be precisely the same. But if you use them both, or you have two different strategies, one's being used with a Keltner and the other one with a Bollinger, you're going to get slightly different signals. And so when you add them all together, you're going to get a smoothing effect of the diversification.
yeah, and that's, it's well said, and it's to the point of what real trading is. You have to have that, going forward. And then also the other thing that's always the most important thing that you talk about more than just about anything else is risk management. I
Yeah.
remember when I first started trading, and I was talking to people, and I'd be like, hey, what should I do? And they would like send me like Van Tharp's book or somebody else's book on risk management. I'd be like, well, why aren't you telling me the secrets? And really that was the secret. It was
Yeah.
here. This is exactly what you need to do. So, I know you've written a few books, and I have all of them, and a lot of them are based on risk management, position sizing, all of these things. Why is that the first thing you always think to go to? And I think I've even heard you talk about the coin flip, and buying things and using possible risk management on that. So could you go into why risk management is always the most important thing for you?
Yeah, risk management, position sizing, kind of all rolls into a general topic. One of the things that I'll credit Larry Height for from Mint back in the day, first Market Wizards book. When I was reading his chapter, I couldn't help but think of the math that he was describing. And he's not much of a mathematician. He's just a street smart guy over
Mm-hmm.
the years. And he said, we always strived at Mint to try to make our bet size the same on every trade. And I thought about bet size to Larry is that's how much we could lose. So that to me translated to the dollars risk on the trade. And we're trying to make the bet size the same. Equity is shifting around. So I started seeing this math of risk divided by equity equals the percent risk. That would be the bet size. And if we made that the same on each trade, then each trade would essentially be allocating a certain amount of risk consistently. So you'd never have too much, you'd never have too little. Too little means the trade's not going to be material to your performance, and too much means it's going to be very material to your performance.
Yes.
Maybe good, maybe bad, but not as predictable. And so that got me thinking about that. And then, of course, there was the famous silver trade I had to go through, and it was documented in New Market Wizards that just freaked me out. Basically, it was a rough couple of weeks there, month. And I ended up making money, but I lost back a lot of open equity. And I realized that, the volatility at the end of the trade was nowhere near what it was at the beginning of the trade. Why did I hold the same amount of contracts through that whole silver trade?
Yeah.
Why didn't I control my position size so that I always have a consistent exposure to volatility? So then as a trade starts out boring and nobody cares, and then it's trending, and some of the trend followers are jumping on, and some of the fundamentalists are thinking this thing's value,
Mm-hmm.
and then it gets going, and then everybody knows about it now, and everybody wants in, and the market's going all over the place, hitting limit moves in the case of some of the futures markets. In those types of situations, you get a very different volatility structure of the entire trade from start to finish. And so I started thinking about that, and I started saying, well, not only do I want the bet size initially to be the same on every trade, but I also want the exposure to volatility to be the same. So if it's a lower volatile market, I want to load up. And if it's going crazy, like limit moves every other day and all that, well, then I want to like back off of it a little bit and just have a certain amount of exposure. As soon as I did that, my return to risk ratios went up. Life got a lot easier. It's a lot easier to be Mr. Serenity when the equity curve's a little smoother. So that's kind of where that all came from. and why I would emphasize risk. And if you pay attention to risk and you actually do studies on it, particularly using trend following models, you'll find that you'll get higher return to risk ratios doing that. And guys like Jerry Parker, with all credit to him, would argue with me, like 100% argue with me, that I would be hurting my returns. And he might be right. And I don't care because I'm a return to risk type of guy. I've designed everything to maximize return to risk. I If I make another $1 million, it doesn't change a thing I do every day, except I got to manage another $1 million.
Yep.
It's not going to change my lifestyle. I'm going to live right here in the mountains during the summer, and I'm going to go down to my Scottsdale home and live there in the winter. And I'm going to play golf at the same places. I mean, my life's not going to change.
And
So
I think the most important thing in that of what you said is the stress of dealing with sizes like that. You know, like I'm a person who does, I kind of hold positions similar to Jerry, but at the same time, that's just me. I wouldn't tell anybody not to vol target because of the amount of pain that you might go through. Like maybe that's not something that you want to go through. Maybe I handle it better. I know people who pyramid, you know, into positions, and I could never even dream of that. You know, for me, it's like if the position's gaining and earning, you know, I'm trying to cut risk, and I cut risk in other ways too. You know, we all have our ways of doing it to do that. Just because of the stress to deal with that, you know, and you know this, every new trader you talk to is always usually trading too big, and you don't see really like huge improvement until they cut their size, you know, and like cutting your size down, however you do it, whether it's vol targeting, just starting really small crap, you know, buying one contract, one micro contract, mini contract at a time, just to learn how to really do it with money so that the money's not stressing you. You know, the money, that amount of money, you know, growing in a position. And you know, I couldn't even imagine at a Jerry level, you know, being this huge fund, and then also you're in futures and this thing's growing, you know, like it could get really wild. You know, I don't even know, you know, how exactly I would handle something like that. That would stress me out. So, you know, I think that everybody, risk management has your own flavor to it, but at the same time, it's always got to be based on what you can handle, because if you're trading too big in any sense, whether just feels too big for you, it's not worth it.
well, it's also your objective. See, like I'm retired. I've been retired for like 20 years now. Jerry's still, you know, involved in the business to a certain extent and has ultimately clients by way of that business and all that, although I don't think he's involved in day to day anymore. But the point is some people are really geared to, I've got to make as much money as I can. It's their goal. And that's her objective. And I'm not going to argue with it. It's fine. My objective is not to make as much money as I can. I really don't care. My objective is to stay retired. I don't want to go back into the money management business. It's a lot more fun to me be sitting here being interviewed by you than for me to be dealing with 10 employees and 40 computers and $600 million under management and trying to figure out how we're going to deal with the National Futures Association stopping by to audit business and all that stuff. You know, my life's good. I don't need it to change a whole lot, and it doesn't suck being me is one of my favorite sayings. And part of that is to keep things easy. And to me, return to risk is a lot more important than return by itself, because I think, you know, if you put me in the right situation, said, Tom, you got to go for return in this particular instance, I think I could handle it a lot better than most people, because I've got 50 years of seasoned trading. And as long as I knew what I was getting into and the swings were going to be wide, I could deal with that just fine. And in any one of my strategies, I can see those types of swings, and I can handle that just fine. It's just that, why am I trying again? You know, like you'd have to put me in that situation, and I'm not in that situation. So why would I want to go after returns? So, like I guess my running 12-month returns the other day, I think I said it was like 7.8% for the 12-month running.
Mhm.
That's fine.
Yeah,
It's
that's a
better
good
than
return.
inflation. It's not changing my life. I could have a run over the next week that would take that 7 up to 12,
Mm-hmm.
whatever.
I love it, because it's a when you get to a certain point in your cap with your capital, there's more of a protecting it than
Mhm.
trying to grow it at some crazy level, and I know a lot of new traders like they don't understand. They're starting with like just like myself or anybody else, we started with a very small amount, but as it grows, it's very hard to keep that capital and be a consistent trader. And I tell people that all the time because people talk about the thing I've been hearing a lot lately from everybody is everybody's gotten stuck in shorting this market, and they're talking about being stuck. And there's no such thing as being stuck. That's a thing in your head. And so they're just kind of in this position where instead of just being disciplined, and to me, it's I think that if you can execute your strategy, no matter what it is, no matter what the volatility, no matter what the position size, and so on, if you can execute it over and over again and stay disciplined with good risk management, you're doing a lot better off than everybody else. And this will make you a consistent trader. But these people, they feel like stuck in some of these trades all the time, and that's just like a figment of our imagination. And really, it's protecting capital. As long as you're protecting the capital, you have room to move to the upside, like no matter what it is. Like you said, like if you for some reason you get something, that you feel like going a little harder in another day or so, you could.
Yeah.
It doesn't change anything. But right now you're happy, and protecting the capital over everything else is always the most important piece of trading.
A lot of getting stuck too, I believe, is predicting. And
Mm-hmm.
I don't predict. I don't. I mean, if you ask me my opinion of which way interest rates are going to go, I would argue that we're getting roughly where we need to be. The
Mm-hmm.
Fed probably is overreacted in the past. It probably overreact in the future. I
Yep.
could go on and on about economics. I spent my life having to talk to people about what the economy is doing and interest rates and everything else. But in reality, when it comes down to trading, the market's in an up direction. I'm long. I've got
Mm-hmm.
30 out of 30 sectors with my ETFs are now long. All of my futures trading is leaning more to the long side until just today and Friday a little bit at the close. So things are starting to shift. Maybe, who knows? But I don't worry about it. I have strategies for upside. I have strategies for downside. I have strategies for sideways.
Mm-hmm.
So let the weather be whatever the weather will be, and I just react. And I'm ready to go. I have the sizing mechanisms in place, so I know what kind of position sizing I'm going to do. It's all done. So I've done a lot of my research and my thinking, and I'm ready to just execute a plan, and I can deal with whatever they throw at me. So get rid of the predicting, and you get rid of the being stuck, because you're not really worrying about trying to be right. You're just trying to measure the trend and go with it, or measure your condition that you're looking for, going with it. So it's set yourself up, execute, set yourself up, execute. And whatever the market throws at you, then you're ready to go.
That's some wisdom right there, because I'm thinking about that conversation, and that's what everybody usually says. I've never thought about it that way, where it's, yeah, well, we're due for this pullback, we're due for this, like that's what you always hear, and it's like I'm a trend follower. I don't like number one, I don't care. Like I'm not predicting anything, just like you. I'm just trying to put on the positions. Oh, I got a new signal. Great. Like you said, like I have to, I have a fund. So talking to people about finance all the time and economics and what's going to happen. That's what everybody wants to know when they talk to you in the
Yeah.
quarter. What's going to happen? Really, like there's a couple, like most of my clients nowadays, I'm like, I have no fucking idea. You know that. Like, at this point,
Well,
I'm just honest.
I probably, even if asked, would not go on a television show that is going to be asking me, well, what do you think the market's going to do the rest of
Yeah.
the year?
I don't
I
know.
mean, because my tongue-in-cheek answer would be anything it damn well pleases. I don't
Yep.
really know.
Yep.
I have no idea. And, that'd be the last time I'd be on that show. Um, and I think that that's sadly there's a whole industry of broadcasting and podcasts and everything that's trying to get at the heart of what is the market going to do next.
Mhm.
And in reality, if you're a good trader and you're just reacting to the conditions as they play out, I mean, you've got governments out there that you can't control that are going to make
No.
decisions, however stupid it
Mhm.
seems they make them, that are going to then create catalyst for potentially market participants to react to. So you don't even know when, say, if the Fed Reserve drops an interest rate, you're not quite sure whether the markets are going to get like excited over that. Hey, we're finally over and we're on the decline of interest rates now. Buy, or they start saying, whoa, that starts looking like we're going into a recession and the Fed's now getting nervous. Maybe we should sell, you know? And then it's sell. And it's really hard for me to sit here and anticipate not only what everybody out there in the world's going to do, you know, government wise and industry wise, large companies making decisions on whether to open plants or to close plants or do lay off people or whatever. And then to actually then also take an assessment of what all the markets are going to react to that news, how they're going to react. Are they going to be bullish, bearish, or just don't care? And it's so much more simple and easy to just measure the prices and look at them, have some indicators set up, have a plan set up, have position sizing set up, and then just feed your data in at the end of the day, run it. Okay, you got to buy this market, sell that market, stop, whatever. For 5 contracts here, 10 contracts there, 7 there. It's all just flows. And then I'm done. And you go on and go hit golf balls or something.
Yep. Yeah, exactly. There's a lot better things to be doing with your time than sitting there trying to predict things that you just don't know. And I love that because it's you know, when you go back through market history, you can see like most of the like even this recent one, you know, the market bottomed in October. Everybody in the world was talking about the recession and it was going to be the end of the world and inflation has finally, you know, killed us all basically. And like the market bottomed at that point. That was when it started to move up. You didn't get buy signals yet, but those came a little bit later. Same thing with, you know, coming into COVID. We're in the middle of a shutdown. The market bottoms. This happens time and time again. You could go as far back as you want to go. You know, most of the time, conventional wisdom and positioning is usually on the wrong side.
If you
Um,
watched the Twitter comments around the COVID crash and you started rallying,
mm-hmm,
and I'm looking at my indicators, and the indicators are nowhere near being hit to go to the
mm-hmm,
long yet, but they're coming down and the market's going up and they're going to meet sooner or later. And everybody gets into, oh, well, this market was so destroyed by the COVID crash, it's got to test the bottom. It's got to
yeah, it's
test
got
the
to test the
lows.
bottom. I remember that.
Perfect V.
Yeah.
Nothing, it didn't test whatsoever. The indicators went over. I went long.
Mm-hmm.
The whole tail end of the year, I made a ton of money.
Mm-hmm.
One of the best years of my life, actually.
Same. Yeah.
And it's just being stupid and following the darn indicators and just going with the direction and not worrying about whether or not you're sitting there. You're not guessing whether there's going to be a W or a test of the bottom or whether the economy is truly going to recover from COVID. You simply are looking at prices and
Mm-hmm.
people are jumping on and you need to get on the train.
And I think it's important for people to understand that you don't know, like you're not getting paid for what the economy does. You're not getting paid whether we go into a recession or not. And some people will always argue that back with me and go, well, you know, you could get paid if you predict. No, you can't. Like, because if you predict a recession, most of the time that's when the market's bottoming. So what does that matter?
Yeah,
So
the
it's
only thing that matters is the buying of this price and selling of that price, and you
mm-hmm,
get that profit in between as a trader. That's the only thing that matters in the end. And if you think about the variables involved there, it's price. It's
mm-hmm,
price buying, price selling, how many contracts you have. If you focus on those 3 things, you're way ahead of all the people trying to predict what the economy is going to be in 2024.
yeah.
Um, just not
which is
useful.
impossible. It's all impossible. And that's I love the way what you do and how you put that together in the book, because you have an all-weather strategy ready for anything. But at the same time, you're not using it in the way like other people have tried to create things similar to that, the permanent portfolio. But this is a systematic way of doing it. This should, over time, be smoother returns, be across more asset classes, more diversification. It's a trader's guide, to really outperforming the market and being consistent over time, and also having some stress off your head. Because as traders, yeah, we could sit here all damn day and argue about what we need to do, and or we could go too big as just a systematic trader in just one thing and make all the money in the world one year and nothing the next year.
Yeah.
Or we can kind of come up with this strategy in your way, and the way you put it in the book. You have this beautiful strategy that's has all these different things, and like you said, you have this percentage of the time when the market's in range bound. You have the part when it's trending, and then you have diversification across assets, and then you have the ability to go long or short. I mean, it's really cool. And if people are listening to this and you're hearing this, like, you gotta pick up the book, because I'm a huge fan of it.
Well,
Reading it really helps me as well.
it's basically my whole trading life, starting from being an idiot and a rookie trader and having no idea what I was doing, but maybe having a math background and engineering and programming and all that, and building piece by piece, and why I did those pieces and some of the logic behind the thinking that went into those things. And I just kind of chapter after chapter keep sort of covering my trading life and how I developed a lot of things, and I explain what I'm doing pretty much. I mean, I pretty much, most people out there with any kind of mathematical background could pretty much come up with something very similar to what I actually do every day. So it wasn't like I was trying to be secretive about it or anything. And I think I used 8th grade grammar checker in there. I don't think there's a whole lot of very long multi-syllable words, so I think anybody could understand it. It's not in the math that I tend to use, you learned in junior high school. So
Yeah.
nothing tricky, nothing complicated. And I think if everybody could just kind of use that as an example, I don't think anybody should try to copy me, because nobody is exactly me. They don't have my capital. They don't have my knowledge. They don't have my seasoning. So everybody has their own financial puzzle. And if they can just use this as an example of, oh yeah, well, I see he's doing that. That wouldn't work for me, but that inspires me to kind of do this instead. And that would capture what I need to solve my own puzzle. And then, so I'm trying to be sort of an inspiring storyteller, to try to stimulate people to look at their own situation and solve it, and use some of the concepts, the general concepts. And hopefully I've achieved that. I've gotten a lot of uh, compliments and favorable ratings on the book. So thanks to all the traders out there that made it so successful. Bestseller in 4 categories on Amazon.
Nice. I mean, it is a great book, and it's like you said, you have people who basically are like, well, I was listening to this guy, or I was, trying to do what this guy did. And really, like, it's all of, you really have to come up with your own strategy, because everybody's different. And also, if like you just take, if Tom talks about a strategy he uses here and you don't back test and you just start using it, when that strategy goes through a rough period, you're just going to throw it in the trash. Because,
Right out
and
the
that
door.
could be, that next trade could be what pays for all your losing trades. And so
Correct.
you have to really come up with your own ideas, your own strategies, become your own person in this, and take your own responsibility. If you don't have self-responsibility, you're not going to last very long in this. If you're saying, well, this guy told me to do blank, or blaming this person for your problems, you really have to be able to go, I fucked up today. I shouldn't
Yeah.
have done that. And that's the thing, you're going to make mistakes, but as long as you're using, those I sentences, and you're taking ownership of those, and then you're able
Yeah.
to come back in and fix that little thing you did wrong next time, now you're really on the path to growth as a trader.
Yeah. That's absolutely true. Everything you just said. Yeah.
Yeah, so I guess the other question I had for you, this is actually from somebody in the group, which was, they said that trend following systems just in general are not profitable. And I think what they meant by that is when it's under a like, when it's a 50% win rate system, lots of people go, oh, that's trash, that's like, but, and that's, well, I don't need to say what I think about it,
Yeah.
but what do you think about that when people say like it's got to have like a crazy high win rate to be a good system?
No, I disagree totally. What it needs is positive expectancy.
Mm-hmm.
And people who are looking at just percent reliability are not really calculating expectancy, because if I have, say, as an example, back in Trendset days, we had a max trend strategy that was around, I want to say 27, 28% reliable. And
Mm-hmm.
people would say, what the heck are you doing that for? Well, the average gainer was something like 7.5 times the average loser.
Yes.
So while they didn't happen every day, when they did happen, they were some of the best and most profitable trades that my company did all year long. And you'd only get one or two of those a year.
Mm-hmm.
But when you did, it made up a ton of money. So being wrong and losing one time, say, making the math easy, four times 25% reliability would be, you have one good trade and you have three bad trades, right? That would work out.
Mm-hmm.
Well, if three bad trades are for one and the one good trade's for 7.5, guess what? You made a ton of money.
Yep.
So
Yep.
that's expectancy. And anybody that just is looking at reliability needs to put that aside, go to investopedia.com, where they define a lot of trading terms across the industry. Look up expectancy and the formulas that are involved in determining expectancy, and try to get your trading strategy over one, and
Mm-hmm.
the higher the better. And part of that is reliability. Part of that is the average gainer and average loss, and limiting your losses properly, letting your gains run and becoming larger is part of the problem. Having reliability is good too. But over my lifetime, and I've been trading like 50 years almost or something, I would have to guess that my reliability is not much more than 33%.
Mm-hmm.
That means two losers for one gainer.
Yep.
That's pretty common in a lot of things that I do, and I've made a lot of money. So
Yes, that's it. It's so well said, and I tried to explain it, but I didn't explain it that well. That's perfect because there's
expectancy.
just yep, and that's it. There's just so many people who they hear about these things and they go, oh my gosh, 30-40%. I can't believe it. That you're never going to make any money with that. And it's like that's not you're not looking at it the right way. If you're losing, 1% of your account and you're making 5% of your account on per trade, like that's or on an average trade in a system, you're making money and you don't have to be right. You can be right one time out of five, and
if
that's
we if we break apart the whole world of indicators and strategies into sort of trend following and non-trend following, two categories.
mm-hmm.
What I have found running just thousands of studies over many, many years, over many, many markets, is in trend following, the longer term the strategy, the lower the reliability, but the higher the average return to average loss will be. As you go shorter and shorter term in the strategy with the indicators, so you get your time periods start gravitating down to just a few days instead of 21 days or 50 days, you're down to short time frames. Now your reliability start climbing towards 40%. I've rarely seen much get above 40.
Mm-hmm.
However, the return to risk, or the average gainer to average loser, starts falling and becomes a little closer to maybe 2 to 1 or something like that. And you start realizing that you're doing a lot more trades. You're still making good money, but and you might have even a smoother track record doing that. But there is the tendency for the reliability to go up, and the average gainer to average loser go down. When you get up on the other side of the non-trend following indicators, a lot of those are embedded in high reliability
Mm-hmm.
systems. So they might be 70, 80% of the time reliable. but their average gainer to loser is starting to get way down close to 1.0, 1 to
Yeah.
1.
Yeah. Yes.
And there you got to rely on your reliability is going to carry the freight, so to speak. In trend following, it's the big winner that carries the rest of the losers, and that gets the job done. In the case of the other indicators, it's reliability that has to stay high,
Mm.
or you're dead.
Yes. And
So having both in your portfolio is not, it doesn't require counseling. It
Mhm.
doesn't mean you have a split personality. It just is logical, mathematical sense that you're going to have different types of markets that favor certain types of strategies, and if you can grasp that in your brain and deal with it, you're just so much better off. You'll be able to deal with more market conditions because of that.
Yes, and it's that's what we do as trend followers. We're hunting for outliers.
Yeah,
these
exactly.
this big trade, that they happen a few times a year that pays for our whole year. It's most of our returns. And sometimes you look at and I've also seen some things happen with very high reliability systems, is that it turns into that they're so reliable that sometimes it causes blowups, and sometimes you'll have people who have these really high win rate systems, and it's the 1 in a million that takes you out. Long-term capital would be one of those examples.
Exactly.
Lots of people get very comfortable in those systems. So, you pick your poison either way. But at the same time, I've always liked the idea behind trend following that, you have small winners, small losers, small winners, small losers, and then some outliers that pay for the whole year. It feels a little smoother in your track record and your returns. And then also, like you said, you can put some other things in there to smooth out those crazy outliers as well, or those range bound periods.
I competed against somebody back in the day, and it's a good story because it talks about this. The guy was doing currency trading, so were we. He was raising all sorts of money, and I'm struggling and straining to get anybody's attention.
Mm,
And I'm just a boring old trend follower doing my thing, and he is buying a currency that might be a lesser currency that pays a high dividend, pays a high interest rate. So it's a country that's got a bit of a higher interest rate for
mm,
whatever reason. And then he would sell at the same time and create a currency pair. He would sell a low yielding currency. So some
mm,
country that's probably usually larger, paying a lower interest rate and all that. And he'd pick up the difference between those interest rates. So he's selling one, buying the other. He gets the interest rate differential. Well, that would be boring if you just did that. So why
mm.
not leverage it? So now you leverage that up, and the returns are pretty good. And they're like every month, this guy is making money, and he keeps bringing in more assets. And I'm going, like I felt like Butch and Sundance in the movie. Looking back at the posse chasing them. Who are those guys? I mean, I'm going, what the heck are they doing? And then I finally figured out what they were doing, and I thought,
Mm.
all we got to do is just wait, because
Yep.
sooner or later, one of those high yielding currencies is going to devalue or whatever, and that's going to just blow up all that leverage. And son of a gun, within 3 years, he was completely out of business,
Yes.
gone.
Yeah.
And then surprisingly, going around selling risk management software. That's what that was his subsequent task after wiping out the CTA business. So
Well, and that's seriously what happens a lot. And it's interesting. I backtest. I'll be vague on this. I backtested a strategy for somebody years ago, and basically, like, they told me that they had this crazy high win rate and it always made money, and it made money every month. And I backtested, and I was like, there's these periods like where it blows up, '08, 2000, '03, '98, 95. It's like across the board. And he was like, well, you just have to predict when there's going to be like some economic turmoil or a recession. And I just sat there staring at him like dumbfounded. Like, is he making a joke right now? Like,
no,
but no, he wasn't. And, once again, he went on to do the system, and that system is no more at the moment. So, It seems to happen, but it's because of,
Yeah.
I think inherently as humans, it's something in our nature that we want to be right all the time. And
Well,
if
and
we're
we want
not
to
right,
predict.
yes.
I guard against predicting, but I still like to predict what the economy is going to do, and
Oh, it's fun. It's a lot of
it's
fun,
fun. And
but
sometimes I'm right, and sometimes I'm wrong. I mean, in this recent rally in the stock market, uh, bewildering to me. I mean, I'm long and I'm making a bunch of money, but I would have never predicted that.
no, and
Never.
that's the thing. I talk to people who are much smarter than me on the market, and just like all of us, I talk to people who are much smarter than me day after day about the market, and they're all bearish, and they're telling me the reasons why, and they're telling me why I should be long. I can't believe you're long tech. Tech is like this, and you're long this thing, and it's like this, and it doesn't make any sense. And they're telling me this every day, and it's like, well, that's cool. The trend is up. And it's as simple as that.
And
The
next
trend
week
is
I
just
might be
up.
short the tech.
Yeah, I don't know.
I don't
If
care. And I
it changes and goes into a downtrend, then I'm short. And
exactly, who
but
cares?
like we talked about, I think that the theme of the interview is that price matters. You don't get paid off of predicting. You don't get paid off of this person's ideas or this. It's looking at the price, identifying, and like Tom mentioned, it's catching that meat in the middle of each move.
Yeah, exactly. And a longer move is more money.
Mm-hmm.
And you don't know which one's going to be a long move and which one's going to be a whipsaw, and you're out next week. They
Yeah.
all look the same when you start out. And so it's just the next trade, the next data point in your next 1,000 trades that you take on as a trader. And you don't put any more emphasis on this next trade than the one after that, or the one after that, or your next 1,000.
Absolutely. Well, cool, Tom. You know what? We're going to end right on that. I think that's a perfect note to end this off on. Just want to thank you so much for coming on again. As always, like you're one of my favorites to have on, one of my favorites to talk to about trading. I always appreciate your time, and you teach people so much with your videos, like in your books. Please keep putting them out, and definitely if you get a chance to check out All Weather Trader, definitely buy the book because it's definitely important in your trading journey.
Thanks, Jason.
Of course.